Hello, my name is Mike Florin, and I'm the owner of Low Cost Mortgage. Today is your weekly update for the week of the 26th or so of January 2024. So rates have gone up a little bit today, or this week actually. Last week they went up on Tuesday. One of the Fed representatives, Waller, actually spoke and said, well, they didn't know if they were going to bring down rates right away or if they'd hold them roughly where they were for a while. They just didn't quite know. And I'm summarizing. But at the same time, what that did is that put upward pressure on rates because the data was coming out showing that the Fed's most likely sooner rather than later going to lower rates, but they're not. They're just going to keep it roughly where it is for a while. At least that's what they hinted at. So the rates reset. They started to come up a little bit, but also we're towards the end of January and next month is February. Every year, for the most part, rates come down November, December, and then January, February, they start to come back up again. So regardless, there was going to be upward pressure on rates simply because of supply and demand of cash. Now, there are two main topics that I want to cover today, things that we saw through the week and also talking to other lenders, just different lenders that I know of in different states. A lot of us get together and we talk about pros and cons, what's working, what's not, things like that. But one of the things that we all picked up on was in the last 6 months, it seems like a lot of borrowers just simply aren't listening to lenders. And it happened a few times to us, and those closings were delayed. And one of them got pretty close to being undoable because of what the borrower was doing. And some of the other lenders that I talked to, same thing happened to them, and it's just a little abnormal, so we'll talk about it. All right, realtors. It is critically important that your borrowers follow the directions of the loan officer or the lender. Loans can get kind of complicated, and not just the borrower can make it complicated, the house type can make it complicated. So for example, a manufactured home will always price a little higher than a stick-built home. So stick-built, manufactured, probably an eighth to a quarter higher for the same scenario, generalistically speaking. And that's true across the board for several different areas as well. You'll have North Carolina will price out differently than Colorado, which will price out differently than Texas, which will price out differently than Washington. So you'll see that in areas and property types. A 2-unit home, a lot of times with investors will price out as a 1-unit home, but a 3 to 4-unit home, a tri or a quad, will price out higher than a 1 or a 2. It's just the rates end up being higher. Different overlays, different risk profiles, things of that nature. So that's going to be pretty critically important for realtors and lenders in order to make sure the deals move really well through the system, that they close fast, so that way there's no hiccups, no delays. One, you've got to watch out for the borrowers and make sure you remind the borrowers, hey, if the lender is telling you to do something, do that. And when in doubt, call the lender, whoever your lender is. If it's us, if it's somebody else, it doesn't really matter. But as a buyer's agent or a listing agent, you should be calling that lender probably 4 or 5 times during the transaction. And if you have any questions, call that loan officer again. And if they don't have immediate answers, maybe they're not in front of their computer, give them a few minutes or maybe an hour to get in front of their computer, do their thing, give you the answer. But remind your borrowers to follow instructions. So it doesn't happen a lot, but sometimes it does, and it usually happens to the borderline borrowers, borderline credit, borderline enough cash, and the really wealthy ones. Everyone in between or in the middle tends to be fine. But if you're borderline on credit or debt to income or cash, or you have a lot of credit and a lot of cash, those are the two kind of polar opposites that seem to not follow instructions as well. Kind of funny, right? But then for property types, again, different property types are going to have different rates. A fourplex is going to price out higher than a 1 or 2, just like we talked about earlier. Also, the rules that apply are slightly different. So the rules that are on a single family home, right, single family regular house, and a manufactured house are different. Extra rules, extra overlays, just extra rules, basically. That's about it. Rate-wise, so that upward pressure in rates, right, and you can see it over my left shoulder here. That upward pressure of rates brought Govy, it's solidly middle 5s-ish right now, depending on your scenario. You can check out our search tool, Low Cost Mortgage or lcmloans.com/rates, search your own scenario. But I just searched one, and Govy was mid fives. Remember, the rates you see there are going to be a little higher than what you would actually get. And we do that for compliance purposes and protection as well. And in conventional, you're looking at mid to low-ish sixes, depending on scenario. So let's talk a little bit about how a scenario would differ. A 620 FICO FHA or VA is going to have a vastly different interest rate than a 700 FICO. But if you get up to 760, not so much. If you put more money down, it doesn't really change rates that much, but it can. There's certain investors out there that are quite a bit better priced, so their money is a bit cheaper, but they have overlays, they have certain rules. So for example, if we've got an A+ VA borrower and they're putting 10% down and they have a single family stick-built home, not manufactured, we can close that puppy in 2.5 weeks. They're going to get a really amazing rate. But then when you look at a borrower that's got a 620 FICO and they're buying a manufactured home and they're putting 0 down on VA, it's a different lender, different investor, different overlays, different rate. So you got to be mindful of that. On the conventional side, you're going to see that same basic thing, but credit score really dictates rate on the conventional side. If you're over 700, you're probably going to go conventional, 720, 740, 760, 780. All lowers the rate. So the higher the credit score, the lower the rate. Also, here's a big key kicker here. If your credit score is over a 760, 760, and you're doing conventional, your mortgage insurance will most likely be cheaper. If in conventional you have 2 borrowers, borrower and a co-borrower, your mortgage insurance will most likely be cheaper. Anyways, name's Mike Florin. Have a great day. Talk to you later, and go sell some deals. See ya.